Hello, everyone. My name is Akil Pyant. I'm joined here by Isaiah Hasward, and we are the managing members of AI Capital, which is a real estate company that invests in value-add multifamily properties in marketable areas. We decided to make this podcast to bring light to you as a real estate professional and how you can add value to your business. Our hope is that through this podcast, we can not only help you out in creative ways to improve your business, but to also provide value and increase profitability. So, with that said, we have our first interviewee, Mr. Yanick Virgil, asset management for Walker and Dunlop, a company that deals with real estate finance. Yanick graduated from the University of Maryland College Park in 2014 with a degree in kinesiology and has also played in the NFL for the Tennessee Titans. Yannick has a few years of experience in asset management where he is in charge of managing investments within the investment portfolio. Again, Yannick, it is a pleasure to have you with us, my friend. Thank you.
Pleasure to be here. Pleasure to be here. Thank you for the opportunity.
So, the first question we have for you is, could you just provide a brief overview of you and your career and why you decided to get into real estate?
Absolutely, man. Again, I appreciate the opportunity. My name is Yanick Cujo Virgil, real estate investor and asset manager based in the DMV, particularly Baltimore area. Currently focused on multifamily acquisitions with my partner, own a portfolio of real estate in Northeast Baltimore, and then also do asset management for Walker and Dunlop. I've been doing asset management for about 3 years now, and it's been a pleasure. So got into real estate, say in 2018, after retiring from the NFL, and it was a blessing. I had a great run at the NFL. Had a knee injury, but one of the books that I read was Rich Dad Poor Dad, and that book really was instrumental for me in just understanding real estate, understanding cash flow, understanding taxes, and just understanding wealth as a whole. Um, and so, one of the reasons I got into commercial real estate in particular was I remember being at a hockey game. I believe it's the Nashville Predators, I believe, or the Nashville hockey team. And I ran into this developer that was sitting behind myself and one of my former teammates, Avery Williamson, who plays for the Steelers now. And he had this nice watch on his wrist, and it was an Audemars. And I said, "Man, nice watch. What do you do?" And he said, "I do commercial real estate. I'm a developer." And so he took me on a tour at a couple of his properties, in fact. And I was just so intrigued by the numbers he was telling me. One building in particular, I remember him saying that he bought it for around 7 million or so. He was going to put in about 3 and then sell it for 15. And I said, "Wow, man, those are great spreads." He was renovating a 3-story or 4-story office building, complete that renovation, and was going to sell it off after he renovated the property. And so, after doing that and also reading Rich Dad Poor Dad, I felt like commercial real estate was uh, more so a space that I wanted to be in, as opposed to residential real estate, because I really understood the value of numbers. Understood that commercial real estate trades at a multiple of income, and I wanted to grow my wealth. So I figured that commercial real estate would be the best asset to do so because when you acquire these assets, you essentially acquire them based off their producing cash flow, and their intrinsic value of their cash flow also determines the value of the asset as a whole. So yeah, that led me to get into commercial real estate, and here I am today.
Definitely, definitely. And let's dig into the journey to that commercial real estate space. So you graduate 2014, you go into the league, 2018, you start that career. When you were exiting College Park at University of Maryland, like what was the goal to, hey, I'm going to play professional football long term, or was it, hey, I'm thinking about other business ideas after football? Like what was your mindset leaving University of Maryland?
To be honest, I always believed in education. I think education is great to have. My mom always told me to make sure that I was, great in school. But my main focus was to get to the league, to be honest. I had a goal ever since I was a kid,
Yeah.
playing football, playing, pee wee football, that I was going to go to the league and play at least 10 years, right? And that's kind of like the number that you find all players whether they come in and they just had a little snack and then left, whether they come in and actually played for about, 10 years, 10, 15 years. Is some reason everybody says that 10 years, right?
Right.
So when I got that opportunity, I was definitely excited, but unfortunately during my rookie year, I had a knee injury that, knocked me out. I tore my patella tendon and had about 2 other surgeries after my initial surgery because I retore it and, I got released going into the second year and, I ended up getting 3 more surgeries to date. So it was a tough ride, but I knew that football wasn't going to be the end all be all, right? We all have a lifespan, but we just really never know when it's going to happen. And so when it happened, that shift, because I was so, one-sided on, or I was so laser focused on that one thing. When it all tumbled down, I really didn't have any idea of where I wanted to transition to. And I was, I'm so fortunate to pick up that book, Rich Dad Poor Dad, because I really don't know what I would have been doing, if I didn't pick up that book. So, the transition was tough. I knew that I was going to the league, but I think, I'm thankful that I picked up that book, Rich Dad Poor Dad.
Definitely. I'm a big believer in adversity is the key to success. And like when you're put in tough positions, you figure out ways to get out of them. I mean, especially, playing football, I play football as well. And it's just like, when I was taking that next step in my career, it was like, okay, what's something that can give me that same feeling that the football field's giving when you're about to make a play? Was it the same for you when you're figuring out, okay, is it real estate? Yes, I can make a lot of money, but the competition.
Well, yeah, man, that's a really good question. I really likened it to football in the sense of building a team. I was always, team captains of any, besides the NFL. I was always a team captain in all the sports that I've ever played, whether it be, collegiate down to high school, even down to, youth league, right? So I always saw myself as a leader, and one of my strengths is the fact that I can build a team, right? I know how to identify core players. I know how to put people in places to be successful. Right. And I knew that's one of the things that I was going to translate in real estate. And, that's a skill that, quite frankly, you can't be extraordinarily successful in real estate without knowing how to assemble a team. So, right. That was one of my strengths. And that's what gravitated me from football to real estate was one of those factors. And so another thing too was just, I couldn't work a job where it was just punching the clock every day, right? In this business, it's always something different every day. Even though it's stressful, you can still make a lot of money. It's always something different every day. So I liken that to a play, right? Offense comes out to me. There's always a different play. There's always a different game plan, and things never go as planned. And sometimes things do, but one thing I know is how to bounce back from setbacks. And so, I kind of felt like real estate was a great fit.
Definitely. I was having a short conversation with Akil before we got on the call. Like our local high school, Eleanor Roosevelt in Greenbelt, we used to get free tickets. So I remember vividly watching you play your senior year and seeing, you're just a monster on the field, and seeing how you transition that into the real estate world is amazing. Kudos.
Yeah, appreciate it.
Definitely, and you already know I've seen you play, Yanick, because we both went to the same college, University of Maryland. Go Terps! Yep. Yeah, so that's great. That's great. Well, so you've talked about the NFL. You've talked about you merged from the NFL into real estate, and how the things that you've learned in the NFL were transferable to real estate. So, of course, when a lot of people learn about real estate, the first thing I get asked, the first thing you probably get asked, everybody on this call get asked is, okay, so you're going to sell me a house?
Yeah.
And it's like, but there's so many more aspects of real estate, right?
Right, exactly.
And one of those key aspects of real estate is asset management. So could you explain what asset management is to somebody that may not know?
Yeah. So in the real estate space in particular, asset management is basically managing the operations and financial performance of the real estate asset. So what goes in line with that is obviously, and to me, anyone that's an owner of real estate, essentially in some degree is an asset manager, right? Because you're managing someone in a sense, right? So what I do basically is I manage the operations, I manage the property manager, making sure that they're doing what they're supposed to be doing, that they're handling, calls, that they're attending to different tenants, whether they have different issues. I'm also managing some of the repair and maintenance that go along with properties, some of the capital expenditures that we have to perform on properties, um, and managing the financial performance. So I'm reading reports, I'm measuring our KPIs, I'm doing all sorts of things that add to the business plan that we have for that particular asset. So each particular asset has a business plan, whether it be small or large. Anyone that's getting into real estate that's new, I would always let them know that your asset has to have a business plan, right? Whether you're looking to either wholesale, whether you're looking to buy and just hold for 10 years, whether you're looking to flip, in a sense, that's asset management. But obviously from a different degree, from a small residential play to a large commercial or multifamily play, it gets a little bit more, intuitive and sophisticated. So that's what, asset management is. And it's really about just making strategic decisions to facilitate the execution of the business plan.
Definitely.
Could you dive a little bit more into, I know you said something key here, to analyze the performance of real estate assets, and you briefly talked about it just now a little bit, but could you dive a little bit more? How exactly do you analyze these performance of these asset management? Like, what measures do you take?
Yeah. So as far as measuring performance, generally you have something called KPIs, or key performance indicators. And those KPIs are based off of targets that you've set for that particular asset. So just from a general commercial real estate terms, some folks, we also look at cash on cash return, IRR, average annual return, equity multiple. From a let's say a leasing perspective or a property manager, they might have KPIs like, how many showings did I do this month? How many leases did I sign? How many leads did I convert from an online lead to an actual visit? So different KPIs that kind of let you know, okay, hey, I'm trending in the right direction. I might not be there, but at least it gives me a target to hit. I think, in order for you to do effective asset management, if you don't have targets, it's just like you're kind of going to work every day, but you have no goals, right? So as far as performance, those metrics are kind of basic metrics that we look for to measure performance based off of what we had in our pro forma when we acquired the asset.
Got it. And what investment strategies would you recommend to improve the income in commercial or residential real estate? So through your experience just with asset management, are there any particular investment strategies that you would recommend at this time?
Yeah. So as far as investment strategies that would improve income, I always like to start at expenses, because expenses to some degree is more controllable than income, if that makes sense. So I'll try to give an example. So for example, if you're having HVAC issues, right? The easiest thing to do to kind of control that HVAC expense is to go out there and replace the HVAC, right? That's easy. But for you to go out there and just get higher rents, it would be more difficult for you to go out there and entice someone to sign at a higher lease compared to going out there and kind of doing something yourself that you can control to control your expenses, if that makes sense. Right. And so a lot of times I like to start at expenses, because particularly controllable expenses like utilities, for example, if I'm in a market where everyone else's apartments, they're charging for water, right? In our property, we're not charging for water. That's a controllable expense that I can bill back on lease turnover, because I know that other people in the market are paying for utilities, so I can now charge that back to tenants once their lease is in, right? Another thing is contract expenses. Just going through all your vendor contracts, your trash, lawn care and maintenance contracts and things of that nature, and just going back and renegotiating them. Whether you have laundry facilities, sometimes you have a laundry facility where a certain vendor is responsible for maintaining the laundry. What's it called? The washer and dryer. You can go back and potentially negotiate those contracts to a better fee. So negotiate the contract so that they take care of the expenses. So I think from starting from the expenses definitely is a better approach. As far as income, from a income perspective, pet fees is one, pet rent is another one, and just maybe a loss to lease. And so, for anyone that doesn't know what a loss to lease is, let's say, market rent for a particular unit is $1,000 and this person is paying $900, then their loss to lease is $100. So I'm losing out on $100 every month because this property is not, or this unit is not listed at or rented at market rent. So upon turn or renewal, I would then go ahead and increase that, by $100 to effectively capture that delta. So those are some things that you can use to kind of increase your income. But I always start from the bottom up because expenses is something that I can control today, if that makes sense.
Why would you say from the bottom up? Why wouldn't you do it the other way? What would make you tell someone, okay, like you're saying we should probably start from the expenses, but if somebody said, well, no, Yanick, we don't want to start from the expenses. We want to start from the opposite end. In what ways would you suggest that is probably, lack of better words, a bad idea? Or
well, you can start where you want to start. I'm saying from a perspective of what I can do today. It's easy for me to get on the phone and renegotiate a contract, as opposed to me waiting for a tenant to turn their lease over in 6 to 12 months, then starting to increase rents, if that makes sense, So that's when I say controllable expenses, because it's controllable. I can do that, 9 times out of 10 today. And that would obviously increase the bottom line on the property. So that's why I started from bottom up, because that's something that I can do relatively quickly.
I see. That makes sense. So asset management, we're talking about, of course, management of assets, but I think a lot of people tend to get asset management and property management confused. So could you tell me in what ways are they different, and in what ways could you combine the two?
Yeah. Yep. So asset management is kind of like an asset manager is the pilot, right? And the property manager is the co-pilot. And so the asset manager is the one that's kind of controlling the whole plane or the whole boat, let's say, for example, and has that 30,000 square foot view and that ultimate control over how decisions are effectively made. And so the property manager answers to the asset manager, but the property manager is more so focused on the day-to-day operations within the asset or within the apartment community. The asset manager is the one that's focused on hitting those metrics, focused on hitting those targets, focused on making sure that everyone is doing their job, because that's the asset management job description, right? You're responsible for the whole operations and the financial performance of the investment. And so you're 9 times out of 10, if you're not the owner, you're the one that's actually reporting to the owner. So you are responsible for the entire operation. So that's kind of the difference between the asset manager and the property manager. A property manager is the one that's, answering those phone calls when the tenant toilet, isn't working, or when their drain clogs up. But an asset manager isn't answering those questions, answering those phone calls. Asset manager is the one that's instructing the property manager, okay, I want you to go ahead and replace that toilet, or I want you to go ahead and approve the budget for you to go ahead and do this type of work, So that's kind of like the difference between the asset manager and the property manager.
I see. So the asset manager is more so the director, if you will, of
Correct.
of the portfolio, while
Correct.
the property manager, of course, helps assist with the execution of whatever needs to get done. The smaller things, not limiting their work, but the smaller things like, oh, the HVAC is messed up. Can somebody come out? The roof is
Mhm.
leaking. Basically, making sure that whatever property that is stays intact and stays attractive for people to come. So I
Correct.
see. Now,
Yep.
to our knowledge, diversification of your investments is important as it pertains to the real estate market in general. So, could you explain that a little bit? Why diversification of some of your assets is important, and just what the diversification of assets is for someone who may be looking at it for the first time?
Yeah. So I think, in any portfolio, when you're looking to kind of scale up to a large level, it's important to have some type of diversification. I think that's the point of diversification, right? Is to hedge against, other things in your portfolio that might be deemed as risky, right? So, for example, we're talking today, January 6th, 2021. We're in this COVID time, and someone might have a bunch of retail in their portfolio, right, or a bunch of office. Well, we know that a lot of people are working from home. We know that with the shutdowns and the reduced capacity, a lot of retail operators aren't operating at a maximum of capacity, and so that could be deemed as a risk, right? If your portfolio is full of office and retail, I mean that portfolio could potentially be struggling, right, at this point. One of the assets that I think is very risk averse and is a counter cyclical play is multifamily. If you take a look at the data running back from even back to the last recession in '08, '06 to '08, multifamily has performed extremely well coming from that recession, compared to single family where or other asset classes where foreclosure rates have been higher, delinquency rates have been higher. We've seen a lot of demand in multifamily just specifically for demographic demand or demographic trends or just how people choose to live their lives. Um, I think multifamily is one of the more risk adjusted investments in commercial real estate. It has one of the best Sharp ratios, which is a measure of risk versus return. And so, I think a portfolio of multifamily is one of probably the best portfolio to have right now because there's such demand for it, and you're obviously meeting the needs of folks that need either food, water, or shelter, right? So there's always going to be demand for that product. But in a general sense, I always tell folks, if you choose to invest in retail or office or some of these, assets that might have a little bit more risk and are kind of more dependent on the economy and people's ability to spend, definitely throw in some multifamily in there because it can kind of hedge your risk and balance out your portfolio. So, that's what, portfolio diversification is.
Mhm. Mhm. It's important. It's interesting that you mentioned that because again, me and Isaiah kind of talk about that all the time. That multifamily is something to invest in as well, because it is the most risk adverse, or at least one of the most risk adverse properties that you can invest in. And you do make a good point as it pertains to, retail, for instance. Certain retail spaces are doing excellent. They're
Yeah.
performing excellent through this pandemic because you may need that extra TV because we're going to be in the house all the time. At Best Buy, you may need to go to Target to get at home items. Office Depot, I can only imagine how well they're they're performing with everyone needing at home office spaces because they're working back home. But for instance, some other tenants may not be the case, and we could say the same things for other sectors of real estate as well. Depending on where the world is, can depend on how much money, how much return real estate professionals get. So it's good that you mentioned that. Now, as we talk about this, one thing that I think we can all agree on that is important for real estate is market analysis. I remember when I first got into real estate, I kind of knew what market analysis was a little bit, but I didn't really know. I was just basing my knowledge just off the term market analysis. But why is understanding the market before you make an investment, why is that important? And keep in mind, anything that you say right now could be transferable to other sectors of business outside of real estate as well. So why is understanding market analysis vital, and how can that have an effect on your income and cash flow?
Yeah, so good question. I think, understanding your market is just a factor of business, right? It doesn't, whether it's real estate, whether we're talking VC, whether we're talking a mom and pop store. If you don't know your market, we're in this business to make money. If you don't know your market and you don't know your tenant base, or you don't know your customer base, you're not going to make any money. So it would behoove anyone that's looking to get into real estate or business in general to understand that particular market before they conduct business, right? Or else you're kind of setting yourself up for failure. Particularly in real estate, market analysis is very important because it's your asset. Obviously, if we're talking specifically multifamilies, for example, your asset depends on income coming into the door, right? So if I'm entering a market that is majority homeowners, and I'm looking to offer a product for rent, that's probably not the best market to get into, right? If I am getting into a market that there's a mass exodus of people leaving, let's say, for example, what happened in Detroit 10 years ago, right? That's probably not a good market to get into. And so, definitely whenever we take a look at potential investments, whenever we take a look at markets, for real estate in particular, there are three things that we take a look for. The first thing is population growth. And the reason that we look for population growth is obviously, our tenants are our customers, right? More people that are coming into that particular market gives us more confidence that we're going to have more customers to fill those beds, right? We like to say heads and beds. So we want to make sure that we have adequate amount of population growth in that particular market, so there'll be a constant demand for our product. We specialize in affordable housing, and so affordable housing is obviously one of the biggest issues in today's society. Is just the demand and need for affordable housing, just because rent growth or home prices are faster than income growth throughout the country. And it's been so for a few years now, well, a lot of years now. So that's one of the things we look for is population growth. The second thing is income growth. And the reason that we look for income growth is because we're in the business of making money. Generally in our pro forma, we budget around 2% for rent growth. And so the reason that we look for income growth, at least about 1.5% to 2%, is because we want to be able to feel comfortable that our tenants are going to be able to afford the rent increases that we project over time, right? And then also, the Fed's rate for inflation is about 1.5% or 150 basis points. So if we have inflation that is expected to rise about 1.5%, and then we get people that are coming in and income growth is growing about 2%, and so we raise rents 2%, then we know that we're ahead of inflation, and we're also getting higher rents based off of the income growth within the marketplace. So population growth, income growth, and the other thing is job growth, right? Jobs are the economic engine of an economy, right? If there are no jobs in your particular market, your economy probably isn't doing well. Case in point, I always like to bring up the point, for example, Detroit, right? Detroit was booming back in the day for automobiles. Back in in the last recession, that was essentially the automobile hub, of America, right? Detroit. And the reason that they collapsed, Detroit collapsed, really is because the auto industry just collapsed, right? And actually they filed for bankruptcy. The city of Detroit filed for bankruptcy in 2013. So you could only imagine how much impact jobs have in a particular market. Again, it's the economic engine of that particular market. One of the things that we look for, particularly in job growth, is just for that Detroit, issue is we don't like to be more than 25% of one specific job in that particular market, right? So, that's one of the reasons why Detroit is, it failed. It filed for bankruptcy is because their market share for that particular space in the automobile industry was so large when the market collapsed. I mean, the entire job industry collapsed, or the economy collapsed in Detroit. So if we can hedge against risk, where we enter into markets where, let's say, it's well diverse, like one of the markets that we like is, let's say, Baltimore, for example. We know that there's education, there's health services, there's some government jobs in there. So it's a well diverse market. So if one job sector kind of starts to shift a little bit, we know that the other ones could kind of pick up the slack, and so that that city or that economy is less likely to fall. So those are the three kind of basic metrics that we look for. And if you take a look at all the strong markets across the country, like Atlanta, for example, there's a bunch of population growth, there's a bunch of income growth with some high tech jobs, and population growth, job growth, and population growth, job growth.
I was listening to you. You said a lot just now.
Yeah, sorry. Population growth, job growth, and income growth. Yeah, and so Atlanta is booming right now, and so that's one of the reasons why Atlanta is a good market.
Yeah.
Right. Yeah. No. Everything that you just named, population growth, job growth, income growth, like you stated, the economy in a given area is very important. So it's important to analyze that when you're looking at your markets, along, of course, with the rents, what everybody else is paying and stuff of that nature. There's other factors that go into that. And that's not just with multifamily. That's not just with asset management. You can do that with any sector of real estate. You can do that with any job that you have right now if you're an entrepreneur. Mm-hmm. Now, those three things that you named, do you use that when you're trying to assess financial risk as well? I know we talked about this in the realm of market analysis, but just to quickly merge back to financial risk, do you use that to measure financial risk? What do you use to measure financial risk? And, what is something that you'll look at and say, no, I cannot put my money there, or no, I can't put my money there because I know my returns will not be maximized. What are some things that you look for, again, when it comes to just risk in general?
Yeah, I think when we talk about risk, that is definitely something that's subjective in the sense that it applies differently to different people, right? Some folks may want to or may be comfortable with investing in New York, right? For example, some folks may be comfortable. There are some folks that invest in Detroit as well. We see a lot of people buying up Detroit right now. Mm-hmm. There's some folks like myself who invest in Baltimore, where Baltimore has been declining in the population growth for the past 10 years. Mm-hmm. I think risk is definitely something that's subjective to some folks. Right. It all depends on the investor avatar, right? What does risk kind of mean to you specifically? How does this investment affect you now? How does this investment affect you in the long term? I think risk is something that's kind of interchangeable between different people. I think for me, for me, taking on risk has to do with a lot of factors, particularly in real estate. The first thing is, the underlying asset, right? I think, we invest in multifamily because, like I mentioned, it's one of the most risk-adjusted, counter-cyclical assets that are proven investment strategies today that kind of go against, recessionary environments, right? So we identify, the underlying asset that we feel like is the best asset that would give us the most return for the least amount of risk, right? And then from there, it's just going into the supply and demand metric, right? We're offering a product. How do we, what does the market look like for this particular product? What's the supply and demand, right? Is there a lot of supply in the market in this particular area in the city? How's the supply in the outskirts, right? Where we are, and if you take a look at a lot of inner cities, there's been a mass exodus of folks, leaving due to COVID, right? They want to leave, or they want to get out of more dense populations, right? A more dense area. So they're going to the suburbs where the rent is probably more affordable, and they can kind of get away from that kind of cluster, so to speak. And then just the demand for affordable housing as well. So we take a look at the asset, the underlying supply and demand constraints, or supply and demand aspects towards that particular asset. The next thing that we take a look for is, the business plan, for example. How risky is that particular business plan in that particular market? How risky is this business plan compared to another property in another market, if that makes sense. So I think understanding that particular business plan and seeing, should I buy a property that's already stabilized, that's already renovated and ready to go? Would this be a good asset to purchase, or should I buy a property that I need to do a full gut renovation on? And obviously that comes with a lot of risk. How risky is that business plan? We both know that development projects are way more riskier than stabilized properties that are already performing, right? So that's another thing that we take a look for. The debt as well, right? So okay, if we identify this asset, we're not buying properties, cash. We place some debt on it. So how risky is the debt? Are we too over leveraged? Can we put a little bit more leverage on the property to kind of boost the returns? Are we in a fixed rate for a long term? Are we in an adjustable rate? Do we have a prepayment penalty? Can we, buy a cap so we can kind of avoid that large spike in interest rate? Different factors that we take a look at when we're looking at our debt. And then the last thing is team, right? It doesn't matter if you have, you have the best asset in multifamily. It doesn't matter if your product has a lot of demand in it, in that particular space with no supply in the background. It doesn't matter if, what business plan it is. It all comes down to your team, right? Can you execute on this asset or not? Do you have the folks around you to surround yourself to see this, goal or realize your pro forma and sell that to investors, right? Because that's what it ultimately comes down to. The jockey is more important than the horse. We've heard that term before, and so that's basically how we assess risk. Can we, once those boxes are kind of checked off, then we say, okay, we can go ahead and move forward and kind of look for this asset.
Definitely. Those are all great points, Yanick. And let's dig into your decision to invest in the Baltimore area. You mentioned that population, affordability, and job growth are the three main key factors when you're deciding on investing in the area. But you mentioned that Baltimore has a declining population overall. So what were your thoughts, and what other metrics were you considering when deciding to focus on that area specifically?
Yeah, so just to dive into Baltimore. So Baltimore is a block by block city. It's one of those cities where it's a lower lower barrier to entry. And so with that, it also comes with a block by block kind of nature. One block might be great, recent sales here, recent sales there, and you kind of turn the corner. It's a completely vacant block, right? So it kind of, you definitely need some intrinsic knowledge on the market in general, and also down to specifics, because it can really kind of, factor your comparables. I think that's important, particularly in real estate, because that's how we ultimately indicate or make sense of what this property might be valued, right? And who's going to come to this property as well. Because if if I'm investing on a block that has a bunch of board ups and vacants, it probably doesn't matter if I renovate the entire property and it's the the nicest property on the block, the only one that's renovated. People are probably not going to come there, you know. So I think understanding Baltimore's inherent block by block nature definitely impacts your ability to be successful in this market. I think to your point about the decline in population growth, before I get to that, Baltimore has also historically been a cash flow city. So the rents are particularly, high compared to the values on that particular asset compared to a DC, for example, where the median home price in DC right now is $1 million. And so the cash flow in those top primary markets are more thin than those secondary or tertiary markets, or a market like Baltimore, where you have a lower values, but you have higher rents. So obviously there is a risk going into Baltimore City. So, we kind of curb the risk by just understanding what block or what areas that we're investing in. As far as just the negative population growth, I think that's due to a lot of different factors. I think one of the factors obviously is crime, right? A lot of people, associate Baltimore with crime. Part of that is from the TV show Wire, but also part of that is from Baltimore's inherent nature of crime. I think crime has gone up in the past couple of years, but I think with new policy and new leadership within the city that just got turned over to, I think, there's some change to come in that particular market. Another thing that might stray people away from Baltimore City is the property taxes. Property taxes in Baltimore, I think, is probably, if not but one of the largest property tax assessments in the state of Maryland. When you think about it, it's really odd, right? You have Montgomery County or PG County that, the income in those areas are much larger than the area median income in Baltimore City. And so it's this very, very strange that in Baltimore cities, you have a lot of cheap properties that are assessed at a higher value, but you get to Bethesda or you get to Silver Spring out there, PG County, and the property taxes are lower, much lower.
Yeah, that's a very interesting metric because sorry, go ahead.
Income tax as well. You're taxed at a higher income tax rate in Baltimore compared to, let's say Baltimore County or let's say some of those surrounding counties as well. So, I mean, there are different kind of metrics that I think, have maybe caused some flight for some folks outside of the city. But I think as a whole, there's definitely money to be made in Baltimore. I think there's a lot of development that's proposed and in the pipeline that's coming to the city. And I've already started I just acquired 2 assets in the past 60 days in particular areas that I know is ripe for development. And so I think there's a lot of opportunity in Baltimore, specifically for cash flow, because I invest for cash flow only. I'm not a proponent of appreciation. I look at appreciation as a pop or an extra benefit to my asset because cash flow is something I'm going to need now, right? I don't want to wait 10 years, 10, 15 years to realize my gains on the property. Right. And so I say that to say Baltimore is definitely a city that people can make money on. You just have to understand the city.
Perfect. Well, lastly, Yanick, is there any advice that you would give to someone who's trying to get into the asset management business? You gave such a great interview on our first episode here.
Appreciate it.
If I was looking at this episode, I might say, well, I want to get into asset management. So what is some key advice that you would give to anybody, young or old, about asset management if they are interested in the words that you provided here today on the podcast?
I would say if someone is new getting into just commercial real estate in general, because to get into asset management or what I do specifically, around multifamily or larger commercial real estate assets, you really have to understand commercial real estate as a whole and just understand the financials behind commercial real estate, if that makes sense, understanding the jargon. But what I'm trying to get to is just get educated. When I first got into the game, I was, looking at different books. I was looking at biggerpockets.com, anything that I can grab onto that spoke about commercial real estate in general, whether it's investment or leasing or anything commercial real estate. I was grabbing onto. One of the programs that I got into is CCIM, which is Certified Commercial Investment Member, and I'm currently working on finishing that up so I can get my official designation. But they have a bunch of classes that you can take that really allow you to learn about commercial real estate and investment analysis at a high level. And so I've always found those courses to be practical and be good information, or good enough information to take actionable steps within my own business as well. So yeah, I always tell people, first thing to do when you're getting into real estate is just get educated. Anything that you could pick up on that specific niche, or if, in this case, asset management, commercial real estate in particular, just pick up a book and just start reading. And then, if you want to get into the space, definitely there are a lot of opportunities out there to be an asset manager, but they're definitely looking for folks who are financially capable of underwriting and financially capable of understanding repair and maintenance and finance and investment analysis, because that's one of the daily tasks that you need to perform to fit this role. So that's what I would recommend.
Awesome. Well, Yanick, we thank you so very much. That concludes today's podcast. For everybody watching, please tune in to our next episode where we're going to be talking a little bit more about architecture and how that can also affect your real estate business, and how architecture can add value to your real estate business. Yanick, thank you so very much, my friend.
I appreciate it. Thank you. Thank you.
Definitely appreciate you and everything all the knowledge that you provided today. Thank you, sir.
Appreciate it.